The final 2 hours of the last of the truncated weeks before we embark on a long 5-day week run. You're watching Midcap Radar live from the CNBC-TV18 Motilal Oswal studios. I'm Hormas Fatakia. With me, as always, is Vamakshi Dhoria. Vamakshi, good afternoon. Well, we are slightly off the highs of the day, though, but still there is some recovery from lower levels. So it's a neither here nor there sort of a case, but there are a lot of earnings reactions that you have to watch out for.
Well, absolutely, Hormas. Lots of earnings trickling in, and the mid-cap end of the market particularly is not doing as well as the broader indices, but the small cap index particularly, if you look at the small cap 100, that is up nearly 0.3%. So there's lots of action. So let's get started with some of the top headlines. Markets give up morning gains with key indices trading near the day's low. Metals, consumer and realty stocks lead the fall while energy bucks the trend.
The metals index has slipped over 1%, dragged predominantly by JSW Steel after the Supreme Court has dismissed the company's takeover of Bhushan Power and Steel and has ordered its liquidation, citing a deviation from the approved plan of a pure equity deal.
Passenger vehicle sales improve in April. Tractor sales also beat estimates, but two-wheeler sales show a mixed trend. The SUV segment sees strong growth, helping M&M wrest the number 2 spot in PV retail sales.
Godrej Agrovet, Phoenix Mills and Indus Towers are among the top losers on the Nifty 500 after their fourth quarter results, while RailTel, Moil has surged. Newgen Software has come off the highs after its results.
$23,400 or thereabouts, that is where the Nifty is at, but there's plenty of action that is happening in the broader markets. The advanced decline ratio has been flip-flopping, and as of now it is in favor of the declines. The Nifty Pharma Index is the top sectoral loser for now. The Nifty IT pack, on the other hand, has picked up steam, especially given the kind of moves that we saw in the US market, but plenty of stock-specific action, and we have now Hormas, who has actually moved across to the wall, and in our special segment, Mid-Cap Movers, he is here with a comprehensive list.
It's a neither here nor there, right? You're heading into the weekend, so it's only fair to say that the market is lacking direction currently. But we'll start off with some of the gainers in the broader markets. Also, there is some recovery from the lower levels. And you can see Jubilant and Grevia there, 7.5% higher. Timken India surged to the highest point of the day, 7% higher there as well. Credit Access Grameen has had a good day at the office, as is CRISIL, building on to the results that it reported earlier this week. Now, also some of the earnings reactions, as we just mentioned to you in the headlines, predominantly negative earnings reactions. Look at Godrej Agrovet now is down 12%. Phoenix Mills is down 8%. Indus Towers has seen a slight recovery from the lows of the day, still down 6%. And Newgen Software at one point was up 13%, but as growth has slowed down in the fourth quarter, they've seen the stock come off too from the highs of the day. Pharma as a sector has been sulking today, barring a few names, but most of them on the losing side. Ajanta Pharma after its earnings, Mankind Pharma too at the day's low, as is JB Chemicals. Stocks that are doing well on volumes, RailTel is one of them, and that is also an earnings reaction. Of course, at one point was up around 12 to 13%. That too is off the highs of the day. Sonata Software and Indian Oil Corporation, after some positive brokerage commentary, is doing well on very strong volumes. And lastly, some stocks that are not doing well other than the ones that we just highlighted before. Data Patterns is one of them, seeing some profit booking after the tearing move that defense stocks saw earlier in the week. Aavas Financiers is down to the day's low, as is KFin Technologies down 5%. So not good going for these names as well, Vamakshi.
Well, absolutely, Hormas, not such a great going for these names. But, just to add to your list, as far as earnings impact is concerned, let's pull up the chart for Ami Organics. The company reported its numbers just a short while ago. The net profit has doubled for the company. The margins have also improved substantially to nearly 28%. That stock has seen a very sharp surge. As of now, it's cooled off from the day's highest point, but nevertheless holding with gains of 4.5%. But, let's slip into a very short break. We'll get you more on the markets and stock-specific action on the other side, so don't go anywhere.
Welcome back and on to corporate conversations. Then Embassy REIT is the first management on the show. After a good fourth quarter, revenues rose 15% on strong leasing, and we are now being joined by Ritik Bhattacharjee, who's the CEO at Embassy REITs, who is joining us. Ritik, good afternoon. Thank you so much for joining in.
Nice to see you.
And you spoke about your FY25 leased area. You exceeded your guidance that you had projected for 5.4 million square feet to deliver 6.6. How are things shaping up now, and what are you projecting for the new financial year?
Well, first of all, thank you very much for having me on the show. It has been a bumper year for us, and we couldn't be more pleased with the way things have panned out. We leased 6.6 million square feet and beat initial guidance by 24%. Most notably, we grew distributions by 8%, the lifeblood of a REIT, as you know, and we're pointing to double-digit growth in FY26. And really, it's fundamentally predicated on the fact that business for us and business in commercial office in India hasn't looked better. If you just think about the fact that there is active dialogue between a lot of GCCs who are still rushing to set up shop in India for the talent, for the ability to service their entire operations out of here, we're the fundamental beneficiary of that in our portfolio. We run a 51 million square feet portfolio that continues to fire on all cylinders. We've got 6.1 million square feet of development coming up that is highly yield accretive, and by any single parameter, we are firing on all cylinders and feel very optimistic about the year ahead.
Optimistic about the year ahead, and that sure shows in your guidance. You've guided for distributions in the range of 24.5 to 26 per unit for FY26. So largely, where is this kind of growth that is expected to come from, and how much growth over the longer run can we expect from you? Also, could you also speak about the occupancy levels that you're seeing?
Sure. If you really think about sort of where office is right now, we're really still in an early cycle as compared to maybe you see sort of residential, obviously sort of falling off a little bit. But that is something that's predicated, again, there are GCCs coming in. We see it, so the 10% growth that we are projecting at the midpoint next year is something that we feel very comfortable thinking about, making that sort of a fundamental sort of going forward. We are putting in 3.2 million square feet of development over the next year, and that's in, cities like Bangalore, which is India's biggest market. We have 75% of our portfolio there, and just really the best assets, we think, sort of in India that cater to companies like JP Morgan, Novo Nordisk, and other bellwether names. Occupancy for us is over 90% by value, if you just look at how big our portfolio is, and we think that ticks up to the mid-90s over the course of the coming quarters.
Bangalore, you said it's your largest market with 75% of your portfolio. Any plans on bringing that number down just to avoid that concentration concern?
We don't view that as any sort of concentration risk. In fact, that's something that we consider to be a strategic weapon for us. If you look at Bangalore, which is India's largest office market, and I know there's a lot of talk about being Silicon Valley and all of that, but for us, it is absolutely a fundamental, the biggest weapon in our arsenal. And we are pan-India. We're in Mumbai. Our portfolio here is 100% occupied. We expanded into Chennai. We are in Noida as well, and we're in Pune. Really a pan-India portfolio of 50 million square feet, and having Bangalore there that continues to fire on all cylinders for us is something that we consider to be very important.
Sure, and a couple of quarters ago, there was a development that came through on the SEZ demarcation. So, what is the kind of conversions that you expect from SEZ to non-SEZ, and what would be the occupancy levels there?
Yeah, so we've actually done sort of 6.6 million square feet of denotifications and demarcation, and we've got a couple more million square feet planned. That process, I think the government's been extremely pragmatic and helpful in making sure that the conversions and that process is something that is as easily facilitated as possible. What was obviously a lot of uncertainty in the market has just become very routine and run-of-the-mill. So for us, we don't even actually think about sort of the SEZ conversion process. What we do see is demand firmly falling in the non-SEZ space. Our portfolio by the non-SEZ numbers is around mid-90s at this point in time. And we are opportunistic and continue to evaluate denotification and demarcation as the opportunity presents itself in our space.
What about the hotels portfolio, Ritvik? And if you could share a mix between the two, where is it skewed towards right now? Mostly office, yes, but how is the hotels portfolio shaping up?
Our hotel portfolio is a very small percentage of our entire asset value, right? But what we see is the hotel business is really picking up for us. EBITDA growth was 25% year on year. We're looking at, and these are business hotels. They're not sort of on the luxury end of the market, but they're following the boom in office because there is clearly travel. You can't sort of get a room anywhere in India these days. If you think about, the quality of the hotels that we provide our office tenants as well, and it's really something that we feel will continue to grow in the quarters to come.
So are you looking to expand that and ensure that people get rooms?
Well, we are building out 2 hotels in one of our, marquee parks at Embassy Tech Village in Bangalore. But beyond that, no, we're not a hotel portfolio business. We're an office business with the hotels acting as an ancillary part of it that we continue to make sure provides value.
And what would be your outlook on the kind of rentals? Are you expecting any sort of growth-related concerns on the rentals, especially given how the economic situation is panning out globally, especially from the global clients? Do you see them sort of, slowing down on their decision-making with respect to leasing out of spaces?
No, look, at this point in time, we've got potentially 20 million square feet of RFPs in the market. Bangalore and GCCs continue to dominate that conversation. And I think for global clients, if you really think about rentals per se in India, they're a fifth of what they play globally. So that's never really the biggest sort of item when you think about sort of the cost proposition of what India is. India is very cheap relative to what you pay in markets like New York or Hong Kong or Singapore. So I think what they look for is scale. What they look for is obviously the talent base. And I think rental growth will continue to sort of be somewhere in the mid-single digits, as we've sort of seen in the past. But it's a very, very attractive proposition for all the companies who continue coming to India.
What about debt? Final question. You refinanced around about 6,000 crores this time around. What's the balance sheet looking like? Any plans on trimming debt down this year? Yeah,
so we're a 32% LTV book. We're very, very prudent about the way we think about debt. And that's around 20,000 crores of debt. I think fundamentally we rely on debt to obviously fund this business. And I think our fundamental focus is to make sure that, we're always prudent on interest costs, on making sure that we get the best financing rates. So we think we're the best credit in real estate credit in India. So, and we aim to make sure that we get the best rates at all times.
All right, Ritwik, thank you so much for spending time and joining us. Wish you good luck for the rest of the year as well. And the management there of Embassy Office Parks REIT, a good quarter and even better projections for the current financial year. Take a short break. Up next, continuing with corporate conversations, the management of Aeroflex Industries joins us on the other side. Stay tuned.
Welcome back. You're watching Midcap Radar on CNBC-TV18. From one management to another, Aeroflex Industries is the next management on our radar. The company posted a good set of Q4 earnings with EBITDA margin expanding and revenue growing 18% year on year. To discuss this and more, we are now being joined by Asad Daud, MD, Aeroflex Industries. Good afternoon to you, Asad. This is Vamakshi joining in. Well, I'd first like to start off by asking about your revenue because, your revenue for the entire year has seen an uptick of almost 18% now. This is much lower as compared to what you had earlier guided for, that was in the range of 20 to 25%. So would like to understand from you, where is this shortfall actually coming in from, and what is your outlook going forward looking at FY26?
So thank you so much. So in terms of our guidance, so our major guidance was for growth in our EBITDA and our profit margins, where we had predicted a growth of about 25%, and we have achieved that. Yes, in terms of revenue, there has been a slight shortfall in terms of our expectation. I think in the last year, you would have seen that there have been a lot of geopolitical situations, including the Suez Canal issue and recently the tariff issues. So those were some of the reasons where we were not able to achieve our targets. But I think if we talk about our targets for EBITDA and for profits, I think we have been able to achieve those. So overall, I think the last financial year was a very good year for us.
What about FY26 then, Asad? What are you guiding for?
So similar growth in terms of both the top line and the bottom line. Obviously, with our increased focus on the high value added products, I think we'll be highly focused on increasing our bottom line as well.
Any specific guidance for the top line? Because I mean, I'm sure there is some bit of risk that is coming in, given that 3/4 of your business is export oriented and a major market is the US for you. So any sort of impact from the tariffs? I mean, if you can just give us a sense of what the tariffs were before this tariff came in, and what they are. So they are actually at 10% now. So is it lower? Is it higher? So any sort of risk coming in from the US market, which is why you're not giving us that revenue guidance.
So in terms of the risk, right, I think from the medium to long term perspective, I feel there will be a lot of opportunities for Indian manufacturers and for Indian businesses to export to the US. There might be some short term hiccups for a month or two or for the first quarter, but I think in the medium to long term, I think we can expect uh, much bigger business coming in from the US. In terms of the tariff percentage, so earlier the tariff for our products was approximately about 4%, which has increased to now about 10%. But yeah, but still 10% is better than what the reciprocal tariffs were going to come. So yeah.
But are you facing those hiccups on the ground currently right now, Asad?
Not much. I think if I see the overall demand, it might be slow for like a few months, but with some of our large customers, we are discussing for a long-term projects as well. So I don't feel that in the long term there will be any impact on these tariffs, as yet. So.
So your exports growth so far this year has not been as healthy as your domestic growth. So do you expect this trend to continue? If you can just help us understand what would be that domestic growth number, what would be that export growth number, and how would this mix evolve, given that exports was somewhere around 75%. So is the domestic portion now going to increase? And another follow-up to that would be, what would be the impact on margins, especially given that the margins in the domestic market are typically lower than what we see in exports?
So yes, in terms of for this, for FY25, we saw a significant growth in our domestic market. I think that was fueled by a lot of the projects that we got. Plus, also we got a lot of new orders from our existing customers, and we also penetrated into new segments, specifically the segments related to ports and also with the irrigation segment. So that really helped to increase the sales from the domestic market. And earlier on, the ratio of export to domestic was 80-20, now which is 75-25. And I think we will see that over the period of the next year also. I think we'll have a more focus on the domestic, especially with kind of the manufacturing facilities coming up in India. Whether it's your traditional sector or your or the new age sector. So I'm expecting domestic growth will still be more than the export. But saying that export will also grow. Obviously, as I told you, like the last 1 year has been pretty, tumultuous in terms of all the things that are happening in the world market. So hence the reason for the higher growth in the domestic. In terms of the margins, yes, export has slightly better margins, but when we sell in the domestic market, our working capital cycle reduces, which ultimately helps us in better cash flows. So yeah.
So despite this domestic shifting focus to the domestic business, Asad, do you still think you have enough levers to take yourself to that 24 to 25% margin projection that you have for FY27?
Yes. So in terms of our margins, right? So we are entering into high value added products. So if you see the sales of our assemblies business for this financial year is now more than 50% of our overall revenue. So hence these are high margin products. And now like we're going to start with the metal bellows. So those margins are much higher than as compared to what we have margins in the hose business. So definitely over the next few years, our margins would definitely be much higher than what they are right now.
Sure, you're adding capacity, and you've already added quite a bit in FY25 itself. When we look at the SS flexible hoses, the composite hoses, the metal bellows. So what is the kind of capacity utilization for these incremental facilities which have now come on board? And what is the kind of revenue as well as margin potential that we can see at peak utilization from these facilities? And just to add on to that, you're also planning to further add capacity in FY26. So for the medium term, Any sort of guidance in terms of what is the kind of revenue margin potential from these additional facilities that will come through?
So in terms of the capacity, so the last year for the hose business, we had a capacity utilization of about 75%. Obviously, some of the additional capacity came in from the Q4. With regards to the metal bellows, so it is at a very early stage because we have just started the production in the last quarter. So optimum capacity of metal bellows would reach probably in the next couple of years. In terms of the margin, so at the peak utilization for all these capacities, our margin will should be well north of 25%.
Final question then, Asad. What about your QIP? Is a question that we ask you every single time you speak to us. When is that happening? You had mentioned earlier that it will happen in Q1 of FY26. We are in Q1. We are done with the first month of FY26 already. So when is that happening? And of course, what about inorganic acquisitions? Once the QIP happens, is there anything that you have set your sights on?
So yes, so as of now, it seems that it will not be happening in Q1, honestly speaking. But obviously, in the past 2-3 months, there have been a lot of I would say the headwinds that have happened both in India in terms of the markets and also internationally in terms of the tariff wars. So hence we are taking it a bit slow, but the QIP is part of our agenda, and we are in talks with a few companies for acquisition. So hopefully in the near future we'll update when the QIP will be launched.
How near is too near, Asad? They say Q2, Q3.
I would say this financial year before Q3.
All right, Asad. Thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. That was the management there of Aeroflex Industries. An important clarification, the QIP that was planned earlier for the first quarter of FY26 will mostly not happen in this quarter. But with that, we call time on this edition of Midcap Radar. We leave you with the Nifty at around 60 points higher. From Mamakshi, me and the team that put this show together, thank you so much for watching. Your stocks on the other side.